want to show you shares of Trans-Canada Pipelines. Under pressure today, down 34 cents at $49.08, still down 12% year over year. Investors are digesting the company's deal with Columbia Pipeline Group, $13 billion. Does the dip make this an entry point for the company? For perspective, we turn to Barometer Capital's David Burrows. Good to have you with us.
Great to be here.
Do you like the trap?
So we have to keep it all in perspective. When the pipelines began their rally back in 2010, they traded at 8 times cash flow. Based on the volume growth that they went through in the boom in energy production, they went to 20 times cash flow.
Where are we now?
Right. Interesting, trap is back at 8 times cash flow.
Okay.
So we are trading now at valuations that they traded at the beginning of the boom, when they were boring cash flow generating assets. So I think that people shouldn't expect these things to go back into hyper mode with 20% dividend growth and trade back at those multiples. But probably TRAP can grow its dividend at 8 to 10% a year.
You can do that with oil not at 50, 60, 70, $80.
With relatively low volume growth. Okay. Now, if the price of oil were to rally substantially, of course that can change. We don't expect that to happen. Typically, when oil has a bust, and it's happened a number of times over the last 4 decades, you get like a 65 or 70% pullback in the price, and eventually you'll get a 50% bounce. Do the math, $26 to $40. It's about a 50% bounce off the bottom. I would expect energy to trade sideways in here in a range of, call it $35 to $45 a barrel, maybe $50 a barrel. You get above that, you're going to get new production coming on quite quickly because the technology, they can turn it on quickly.
Right. They flip these switches virtually and it just...
They can turn on production in 12 or 15 days.
Right.
So, like after the tech boom, you shouldn't expect these things to go right back into hyper mode. I think that likely the industry is going to restructure for probably a couple of years.
We're sort of seeing that, this $13 billion acquisition.
Right. So assets get spun off, equity deals get done. There's going to be lots and lots of equity deals, I think. So that's going to keep a lid on things. But in the meantime, a company like Trans-Canada Pipe was able to buy a great asset that will help them probably grow their dividend a little quicker. So for those who are looking for a pretty stable dividend and maybe a little bit of growth, this is going to be a great position. If I were looking for growth, I'd be looking for things that benefit from low energy prices and stable energy prices for more upside. But this is going to be a pretty good total return.
Okay, so if you're thinking about industry sectors that benefit from cheap energy, I guess we're talking about the industrial space, the discretionary stocks.
Right.
To a lesser degree, I suppose, technology.
Yeah, I think all three. So we are big believers that the U.S. economy is going through a slow, steady restructuring and improvement that benefits from low, stable energy prices. So you want to focus on things that do well in the domestic economy in the U.S. Consumer discretionary is one of them. The housing industry has been restructured. The millennials are starting to actually get married, and household formation started to pick up. So things like Home Depot and the home builders look kind of interesting. Industrial companies that benefit from relatively low energy prices.
Right.
That looks pretty attractive.
Okay.
And that's something that can grind higher here as we go forward.
Okay, so you mentioned Home Depot. Let's look at Home Depot then. 2.1% dividend yield, trading with 21 times forward earnings, whereas Lowe's in the United States is trading at 18 times forward earnings.
But look, Home Depot has grown its dividend 26% a year over the last 5 years. They've grown market share against their competitors, including Lowe's. It's a really, really well-run business. They've got a very high component selling into the professional market, not necessarily just the home do-it-yourselfer.
That Home Depot largely got out of that space.
No,
they had a whole separate division for it.
They had a separate division, but they've grown that. They've grown market share in that space very, very well. Now, interestingly, the energy industry goes through restructuring. A whole bunch of jobs are shed. Where are all the workers going? They're going into the home building industry. Home building industry hasn't been able to get enough workers to build homes quickly enough. So it's an interesting transition. I would just prefer to focus on where the money goes next, not where it's been for the last 5 years.
Okay, well, Home Depot over the last year is up by about 16%. Do you think the run is done in that particular equity? Or
I really don't. I like that space. I like the whole home building. You can buy an ETF like ITB or XHB. Both of them will give you broad-based exposure to companies like Masco and Acuity Brands, companies that sell products into Home Depot and the home builders, and the home builders themselves. And I think that's very attractive. The U.S. economy, despite all of the comments in January and February, has continued to slowly plod ahead. And I think that that's likely to continue.
Okay, so I pull up the XHB here, of which the top 5, you've got Lowe's 5th, Home Depot 4th, Pulte Group 3rd, Masco 2nd, and then Whirlpool at the top of the list. This
Right.
is, I guess, those millennials, I guess some of them get to buy houses somewhere, just certainly not in Toronto.
There's like 9 million people living in their parents' basements. And you know, interest rates at, you know, close to 1,000-year lows aren't a bad place to start.
Your lows. Okay, so then you go Whirlpool, and this is, okay, we got to upgrade the dishwasher, we got to upgrade the washing machine, all that kind of stuff.
Right. Look, the U.S. consumer restructured. Canadian consumers still got lots of debt, right? But the U.S. consumer has restructured. Their home prices are slowly moving higher. You know, they created millions of jobs last year in the U.S. I mean, this is not something that's getting worse. It's getting better. And in general, the U.S. is probably the biggest beneficiary of relatively low energy prices. And if you think you could turn on production quite quickly, stable supply is really attractive. They haven't had that in 40 years in the U.S.
David, thanks for coming in on a Friday afternoon.
Thanks for having me.
David Burrows is the president and chief investment strategist at Barometer Capital Management.